I want to emphasize that we're in an economic downturn.
This isn't a financial crisis. What you really do have is an economic crisis. People are staying home. People aren't spending money.
There's no way to avoid that. The question is, will it be a depression?
It is a massive buying opportunity. I think you're never going to be able to time this thing.
Follow the money. Where is money going to move to now? Where does money have to move to?
Look at that red board. It's the biggest opportunity in the history of the world.
As Buffett always says, you always buy when the bears are selling. And when the bears finally give up, that's when you go in just 3 weeks.
There are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen. I mean, for example, in our insurance business, we could have the country's #1 hurricane that it's ever had, but that doesn't preclude the fact we could have the biggest earthquake a month later. So we don't prepare ourselves for a single problem. We prepare ourselves for problems that sometimes create their own momentum. I mean, 2008 and 2009, you didn't see all the problems the first day when what really kicked it off was when the Freddie and Fannie, the GSEs, went into conservatorship in early September, and then when money market funds broke the buck. I mean, there are things that trip other things, and we take a very much a worst case scenario into mind that probably is a considerably worse case than most people do. So I don't look at it as huge, and I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, have it go down 50% or more, and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred, but if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, I mean, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others, and fear is something I really never felt financially, but I don't think Charlie's felt it either. But, some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks, because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to.
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance.
The data is
in business school.
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses. Well, if I were on Wall Street, I'd probably be a lot poorer at... you get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's simply an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about. And that may be too bad, but, why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
You have to do something. So let's tell you, back in 1987, when that stock market crashed, I still remember it was 87. I was in Honolulu Airport. I was flying in from Sydney, Australia, and I get up and they say, the market has crashed. Oh, I'm on this is before cell phones. I'm on the phone going, the market crashed. I dropped to my knees, broke out the rosary beads, even though I'm not Catholic, and took laps around the beads, say, thank you, God. Thank you, God. This one is crashing. And for those of you who remember 87 and old enough, it wasn't just subprime crash. It took out the entire savings and loan industry. I mean, a whole banking system collapsed, and the savings and loans collapsed, just got taken out. And it was taken out by an 86 Tax Reform Act. And the 86 Tax Reform Act basically screwed professional people, doctors, lawyers, and accountants. It took this phony tax-based write-off system away from doctors, lawyers, and accountants, as they should. They have no business being in real estate. Just took them. So this market just kept crashing, and I kept saying to Kim, yes. So it's 87, 88, and it just got worse. And that's at 1989, at the height of pessimism, or the depth of pessimism, I said, yes, this is it. I'm going to get rich now. Everybody was crying the blues. And as Buffett always says, you always buy when the bears are selling. And when the bears finally give up, that's when you go in.